Good afternoon, it's Jeff Christian, CPM Group, about 12:15 on Friday, the 11th of June. Going to talk today about how CPM Group projects prices. And the reason I do that is after our video last week, we got a couple comments. One was, CPM Group takes a lot of flack from people who don't know what they're talking about because they think that prices should only rise and never fall. But the reality is that we have a pretty good track record in calling both short-term and long-term gold prices and silver prices and molybdenum prices and platinum, palladium, rhodium, ruthenium, iridium, uranium, cobalt, and a variety of other commodities. And how do you guys do it? We don't know that. So a couple of them said, wow, guys get it right. Be interesting to know what it is. And then this guy at the bottom, Krishanu Roy, I just love him because he was like so tone deaf. I mean, if anybody has proven that they don't listen to what we're saying or read what we're writing before they comment on it, Krishanu really has done a tremendous job. Yeah, we do come up with weekly price projections every week. So anyway, so I wanted to talk about how we do our research, because it's very important. There was a conversation once I was having with the head of one of the world's largest precious metals refineries. And I said something about our competition, and he said, who do you think your competition is? I said, well, it depends on which sector. In terms of advising companies on hedging strategies and financing arrangements and advising institutional and high net worth individual investors, the banks are our major competition. And, but I was thinking about people who provide what's ostensibly research, but it's really marketing documents. And I mentioned a couple, and he said, those guys aren't your competition. You sell research, they sell advertising. And that's actually very true. And it's very important to understand the differences that you'll see in CPM Group's research and analysis and work, and other people who are being paid to promote gold or silver or platinum metals and will have different data than we have for a variety of reasons. So the first thing about how we do our price projections is we do research. We do very intense research. I've worked probably 70 to 90 hours most weeks of my life, even going back into high school. And most other people at CPM Group probably work 70 to 90 hours a week too. We love our work. It's very interesting. It's very fulfilling, both on a variety of ways, including intellectually. And we study these markets very seriously and with the intent of getting them right. We study the markets, the industries, the mining companies, the smelters, the refiners, the fabricators, the recyclers, the providers of retail products for investors. We study these markets very seriously and objectively. Our clients don't pay us to be bullish or bearish, the other guys. Our clients pay us to be right. So we provide research and consulting, including commodities management and asset management and investment banking advisory services to companies across the industries, to governments, central banks, exchanges, institutional investors. As I've pointed out in past videos, which has largely gone unrecognized by the people who don't listen for comprehension, only for confirmation, less than 1% of our revenue comes from sell-side financial institutions like bullion banks. We provide research and consulting to companies that produce, process, or use metals, and to investors who are seeking to have more efficient and effective investments in these metals. And that work in rolling up our sleeves and getting involved in metals transactions actually gives us knowledge and insights into how the markets work that you just can't get if you're a desk analyst. And by knowing how those markets work, we can assist our clients to be more effective and efficient in their investments, and we can improve our research. So as I said, we work hard to be right. What we don't do is we don't base our research on beliefs and fears. And we're not the kind of company who's going to sit there for 40 years telling you the world financial system is going to collapse, the dollar is going to collapse, the treasury market's going to collapse, and gold's going to 10,000 or 20,000 or 30,000, and silver's going to $100 or $1,500 or $13,000. We don't sell our research based on fear. And we sell our research on our track record. And one of the things I don't understand, it's something about my psychology, is how it is that people will latch on to people. I mean, there's a guy who started his newsletter in 1982 or so, and his first newsletter said the treasury market is going to collapse. And he's still saying that 40 years later, and he has 200,000 subscribers or more. It's like, at what point do you say, well, this guy got something wrong in his model? I just don't understand how somebody can tell you that the world's going to collapse and gold's going to 10,000 for 40 years, and you're still listening to him for advice. But that's me. I have that problem. When we do our research and our projections are at variance to what actually happens in the market, our assumption is that the market is right and our research is wrong. Now that contrasts with a lot of true believers who say, no, if I can't possibly be wrong, I'm so smart that if I said that gold's going to 10,000 and it hasn't, it must be a rigged market. It's the ghost in the machine excuse for your own incompetence. Yeah, I couldn't possibly be wrong. And I've seen people do this. I've seen people start cottage industries spreading conspiracy theories because they got gold wrong. We don't do that. We don't base our research on conspiracy theories, and we have a pretty good track record. I'll show you some in a little bit. We look at concrete evidence, and that's what we base it on. Now, we've always talked about, since the late 70s, early 80s, the 4 pillars of research on which we base our work. The first one is fundamentals: supply, fabrication demand, investment demand, inventories for gold, central bank activity, recycling. The fundamentals, microeconomic, ground up understanding of the market, accentuated by the fact that we're involved with a lot of companies in it, so we understand exactly how these metals move around and how companies handle them. We sometimes actually manage purchases, sales, scrap recovery, sales of excess inventories for fabricators who don't want to be involved, as well as hedging strategies for producers, processors, refiners, and smelters, and fabricators. The second pillar is a macroeconomic top-down understanding of the world, not just the economy, but the political environment. As I pointed out in the past, my degrees were in journalism and political science. Political science was international economics, but that's beside the point. It was political science. Politics are very important. The first nonfiction I ever was paid to write was an analysis as to why the Chinese government invited Richard Nixon back and treated him like royalty after he had been forced from office. So it was a political analysis, not an economic or a market analysis. I was doing commodity research primarily in oil and gas at the time, but a little bit of precious metals and such too. Macroeconomic, financial markets, monetary systems, currency systems, and political analysis. That's the second pillar. The third pillar is what we call market mechanics. And these are shorter term developments in the markets that don't necessarily show up in supply and demand. And you will have heard me talk about, for example, the rules of active futures contracts from one month to another having a shorter term price effect. And the fourth pillar is technical analysis. And we only use that to place our projections. Our projections, gold's going to a record price probably over the next 5 or 10 years, is predicated on the fundamentals that we see in the market with no ghosts in the machine, no conspiracy theories to prove it, and our macroeconomic top-down analysis. once we think we know what the range of prices is going to be, we look at technical analysis to understand the timing and the pacing of price movements. And you see that a lot of people don't do that. So they'll say, oh, yeah, we'll say, oh, we think that the silver price is going to X dollars. And we probably think we'll get there within 12 months. Other people say, no, it's going to X dollars next week. But you look at the way the market works and you say, gee, that's not how the prices ever behaved before. It's not to say that it can't be that this time is in fact different, but there's a certain pacing and timing that's common across markets and specific to individual markets. And you pay attention to that so that you can develop reasonable expectations and projections as to the pacing and timing of the market moves. And it's important not only for the individual market and price, but it's also important for those macroeconomic developments. So the guy who in 1981 was telling you that the treasury market was going to collapse, he just got his timing wrong. You have to pay more attention to the timing. Our shorter term projections are a little bit different. It's more market fundamentals are there, financial market trends, interest rates, currency rates, oil prices, stock market, a lot of those other factors. One of the nicest criticisms of me was in 1988, 89. We had called a peak in the gold price at $500 in early 1988. Other people were saying it was going to 10,000. We were right. And somebody asked an analyst in Australia what he thought about our research. He said, well, CPM Group's not good at projecting gold prices. It's only good at projecting economic activity and the stock market and interest rates, because those are factors in our model for gold prices. And I'll take that kind of criticism any day. And the reality is, one of the things that's distinguished our research from other people looking at precious metals in a serious research perspective is that we have spent a tremendous amount of time on our economic model and our understanding of the financial markets, the competing assets. And one of the things that you're seeing right now is the competing assets have a lot to do with where the gold price is, always does. So we pay a lot of attention to that. And then there's that market information. Again, the shorter term, things that don't show up in fundamental supply demand analysis, physical developments, as well as things going on in the futures market. Technical analysis comes in. And there's that thing, that knowledge of the ebb and the flow of markets. Prices have pacing. We call it a sense of market. I said sense of markets here, I'm sorry, sense of market. It's a sense of a market. This is what a market looks like. This is the gold price over the last 11 years. Up and down. When it goes up, we say, well, we're less bullish than we used to be. When it comes down, we're more bullish. Prices go up and down in markets that are basically more or less relatively open. And you'll find those guys say, well, no, gold prices can only go up on fundamentals. And if the price comes down, it's because some conspiracy is slamming the market down. No, this is how markets work when they're not managed. This is how markets work when they're managed. The left-hand side is West Texas Intermediate crude prices from 2000 to 2008. And you can see that channel that I did. That was a managed market. That was OPEC, led by the Saudi Arabian government, saying, we have discovered that if we don't disrupt the markets, if we don't have a volatile increase in oil prices the way we did in 1973, 74, 1979, 1980, when we quadrupled prices overnight, if we slowly but surely increase prices and we make sure there are no gasoline lines, we won't destroy demand for oil. So we're going to let this out. And there was a Sheikh Yamani who in the 80s had said to the Saudi government, hey, if we do this, we can raise the oil price significantly. And they fired him, even though he was part of the family. But he wrote a book about it. And he said in the 80s, we can do this. If we don't disrupt the consumption patterns of oil, we can raise the price substantially. By the Saudis were desperate for higher prices, and they took his policy to heart and they implemented it. And the oil price went from $10 a barrel in 2001 to, well, ultimately 140, but that was the blow off. They got it up to $75, $80 a barrel, and no one was really complaining. That's a managed market. The right-hand chart is the US S&P 500 index. And you can see from 2010 to 2019, really, very steady increases. That was decapitalization, stock buybacks, monetary and fiscal largesse. It was companies saying, if we take our profits and instead of building new factories, hiring new people, buying new machinery, if we take our profits and buy our stock back, the price rises. The shareholders are happy, and they give the CEO even more money. It's terrible for the economy, but it's great for the CEOs and shareholders. And that's a managed market. You see something like that, you say, okay, I'm playing with a professional on the other side of the market. Here are our intermediate-term gold recommendations from December 1980, when we started keeping records, until now. You can see red lines where we're saying, we don't like gold. You know, first week of December 1980, when we started this stuff, so I said, do you want to buy gold? The price is $5.95. I said, no, I would sell gold. We're going into a recession. The price has gone up from $200 to $850. It's come back down to $600. I'm a seller at this level. And we kept that sell recommendation in place until June, July of 1982. Price had gone down to $325, and we issued a buy recommendation. Price got up to $500 within 6 months. I had some problems. I was working at Goldman Sachs at the time. I said we should sell. Oil prices were cut. Inflation rates were coming down, and I said we should sell. But it took them a while. The price had gotten down to $420 before they let me authorized me to issue that sell recommendation. But these are our buy and sell recommendations. Now, when we say sell, you think, well, you can take profits on what you got, and you can also sell short. If you just on December 4th, or whenever the date was, 1980, bought gold at the time that I said, don't buy gold. You just bought that gold, you would have had an annualized return on that physical gold of 2.7%. Price would have risen sharply, you know, 182% increase in price, 2.7% return. If you had bought gold when we said gold, buy, but just sold the gold you had and not go short, when we say sell, just sell the gold, put the money in treasuries, you would have 8.9% return. If you had bought when we say buy, sell your physical when we say sell, and gone short, you would have made 12.9% return. And you can see from the bars, you know, you would have done a lot better if you were actively trading a market in which the price rises and falls. If you can find it in your mind to not believe that prices can only rise, and that anytime the price falls, it's because of some grand conspiracy to suppress the price. If you can understand that in markets, asset prices rise and fall, then you can make a lot more money than just buying the stuff and putting it under a bushel. Here's our silver recommendations in the same time frame. A lot more activity in the early 80s, and you can see from 1980 to 2000, 2002, we were buying and selling gold and silver. Since that time, well, we issued buy recommendation for gold in 2000, silver in 2001, and we didn't lift them until the end of 2011 or the beginning of 2012. And then we issued buy recommendations more recently. And even more dramatic returns if you're willing to buy and sell. If you understand that prices rise and fall, if you can buy at $5 in 2005, if you can buy at $5 in 2005, and sell at $40 in late 2011, and then buy it back at $15 in 2019, you're going to do better than just holding that stuff. Those are your returns. And this, I wanted to mention at the outset so that people would stick around. These are our current views. For gold, we're looking at 1800 to 1965 as a short-term range over the next 3 months or so. You are going into summer doldrums, but we've had this pattern last year in 2019 and 2020 where gold prices have risen sharply in July going into the August COMEX delivery month. That has overruled the seasonality, which would suggest that normally, typically gold prices are weaker in the period May, June, July, August. That's been that seasonality has been overruled by other factors, those short-term market factors, and we think they may well be again this year. Intermediate term, next year we're looking at a range of maybe 1925 to 2025. So higher prices next year. I think very nice increase. Other people think it's crazy because it's going to 30,000. And then longer term, we are looking for annual prices to rise to around $2,900 in nominal terms at some point over the next 5 to 10 years. And I'll be a little bit honest, that 5 to 10 years looks more like 4 to 5 years to us. But it really has to do with what happens in terms of global economics, financial markets, monetary policy, and politics. With silver, similar pattern. Some range bound, we've been range bound $15.80 to $30 for most of the last umpteen months. It's not umpteen, but it's probably about 6 or 9 months. We think that that range may hold. I'm not sure that it's going back to 25.80. There's very strong support around 27.20. And in fact, today we issued for our clients who pay us for short-term silver trade recommendations, we said we wouldn't be surprised to see the price get down to 27.25 or so over the next 2 weeks. But we also don't see a lot of upside either. We were in this channel, as I said, 27.25 to about 28.80 over the last several weeks. And we're probably going to continue. At some point, we're going to break out. We thought we might have broken out on the downside over the last 2 weeks, but it didn't happen. Intermediate term, $28 to $30 really for 2022. A little bit of spikes below and above possible, obviously, because that's a very narrow range for silver. And then longer term, we're also looking for record prices, possibly around $54 on an annual average basis for nominal prices at some point in the next 5 to 10 years. So that's how we do it. No magic. We don't get a call from the Fed or from JP Morgan saying, hey, Jeff, we're going to dump and slam the market, so issue a sell recommendation. I always tell the story about 2013 when Goldman Sachs started the year by saying that, hey, gold, which is around $1,600, is going to $2,000 this year. And at the end of March, they realized that for the first time, probably in record, there was this massive record short position from institutional investors on the COMEX gold market. They were recommending buying gold, and their customers, the institutional investors, were basically shorting gold. So in early April, they came out with a sell recommendation. A few weeks later, in China, you had a massive amount of gold being sold that drove the price below 15.80 to 13.80 to 12.80. And the wags in the market said, oh my God, Goldman Sachs slammed the market. If you looked at the data, there were more than 1,000 independent entities selling gold in a 5-minute period on COMEX that morning. Everybody was looking at the price. Everybody was saying, if it breaks below this trigger level, we're going to sell. And it did, and they sold. And when I pointed that out to a meeting of gold bugs, somebody seriously said, you mean the Fed has more than 1,000 agents that work for it? I said, no, I mean that there are more than 1,000 people who use the same price charts and the same technical analysis to decide whether to buy or sell. It's the way the market works. If you understand the way the market works, you can ride it. If you don't understand it, it's going to be like a Bronco and it's going to chuck you. Buy our research. You can sign up for our research retail investor programs. We're going to have our Challenge Your Assumptions open Q&A webinar 2 weeks from now on Tuesday, the 22nd of June. If you're a client, you can plug in and ask questions. If you really want to understand the markets, buy our silver yearbook or our gold yearbook. That's where the 4 pillars are discussed. Fundamentals of supply and demand, the macroeconomic environment, what's going on with investors, inventories, futures, and overall markets. That's all for today. Have a good weekend. Take care. We'll talk next week.